Peace, love, and blessings, y'all. I hope you're having an amazing day. So, off the bat, this is going to be an investing channel. So, we're going to talk about all things investing. So, to start this conversation off, what is investing is really more important to take a step back and understand what is money, what is currency, and how does money work. So, money is gold, silver, and any medium of exchange, any real medium of exchange. Okay, so just a brief history in that is currency was created by us having gold and precious metals, copper, stuff like that, where you can have a token, a coin, a metal coin be worth something of significance to be a medium of exchange. So that's taking us away from bartering, where we're selling instead of just exchanging goods for their own service or for their own good, we're exchanging a product or service for that medium of exchange instead of trading item for item, because that's bartering. So what money is that real valuable, like you could even consider commodities, things like oil, and other food and stuff like that, money. But the true root of money is just metals, traditionally gold and silver specifically. So what happened was, then there came a bank who said, hey, we're going to have a safe haven for your gold and silver, for your money. So what happens is you put it there and it's safe. And then they're like, well, here's an idea. What if we just give you an IOU to say, hey, you have this much gold, so we're going to give you X amount of currency or IOUs, right? And that's how currency was formed. Because eventually they just got to realize, well, hey, we don't need this gold stuff anymore. They start lending it out so that they can make money on money, which is exactly what banks do to this day. And that's how we got started. So currency is nothing. Currency is an IOU, a debt instrument. So that's what fiat currency. So when you hear us talk about fiat currency, that's what we're talking about. The US dollar, Japanese yen, Swiss franc, all those different currencies. Those are examples of currencies and not true money. Gold and silver will always be what's considered to be God's money, which is something that you hear some economists today say, gold and silver are God's money. But it's also something, if you follow on a spiritual level, or ancient civilizations, they used to talk about the gods, the Anunnaki, and some of the other gods would talk about people from out of this space, out of this world, would say that is God's money. Gold is God's money. So anyway, that being said, now that we understand what money is, the banks use our money to leverage so that they can make a profit. So when you keep your money in the bank, it's not helping you, it's helping them. Back in the day, they used to give you some sort of a ROI. Now it's like a fraction, a tenth of 1%. So that's not really what we want. So how does money work? So money works because it allows us, whether you're working for money, whether you're having passive income, active income, whatever it is, either way, you get money and you can buy things with money. The problem is the system is set up so that inflation increases the cost of living. That's the definition of inflation. The cost of living increase. So typically, the system is set up this way, mind you. So the people who benefit from this system are the people who know how to take advantage of the system, the people who understand and understand how it works. So now we know what money is. Well, inflation is equally important to know, because if you have money and you don't do anything with it, like say you leave it in the bank, it's not making you anything. Every year it's worth the target for inflation. It's like 2%, 2.14%. That's considered a good ratio for inflation. So now inflation being at 2%, say 2% for simplicity, if you have $100, 2% of $100 is $2. So now next year you have $98. Then the year after that you got $96, and that's compounding interest. So it'd be like a little bit more than 96, a little bit more than $2 because 2%. Anyway, so but that's the reality of it. Even though the number is the same, you might still have the $100 in there. It only gives you $98 worth of buying power. That's another good thing to understand, buying power. So now with inflation increasing at different levels, say like back year to date, I think it was June. Yeah, it was June, where we had inflation at 9.1%. So that means inflation was near 10%. So you literally lost 10% of your buying power during that month because inflation had gone up so high. So the prices of goods were going up so high that if you're not making enough income, if you're not making more income, you're feeling it, right? Or if you're living, I want to say beyond your means, but if you're living, because I know people do live beyond their means. That's a whole other thing. But if you spend so much of your earnings, right? Because they say like more than 2/3 of America spend most of their income on the things that they need throughout the, I'm talking about the food, the gas, the rent, all those expenses equate to mostly all of their income. So that's an issue, because now when prices go up, I mean, your income isn't going up too. Matter of fact, your real income is going down because the buying power is going down. So this is why investing is important. This is why learning economics is important. And there's two different types of economics, just to tie this in together. There's microeconomics, where you could look at, microeconomics is a smaller outlook. So if you're looking at like one company in a sector, like that's the microeconomics of that sector. Or if you're looking at one sector, or if you're looking at one county income versus the state, or if you look at the state's income versus the country, or if you study a country versus the world, that's micro. So macro would be the larger picture. Macro would be looking at the whole state instead of a city or a county. It'd be looking at the whole country instead of a state. It'd be looking at the whole world, which is the true macro, looking at world economics, because everything, especially with the way everything's digitized nowadays, everything happens so quickly. So when China has COVID, or when China has something going on there, that's going to directly affect other markets because of how much manufacturing goes on in China. So if you look now at Apple and a lot of other countries, a lot of other companies that are moving out of China for those reasons. Okay. So now looking at the macro is important, because once you see certain things happening, you'll know, hey, maybe it's a good idea to take advantage of this. Maybe it's a good idea to move my money away from this. So that's the significance of macroeconomics. And it's really important as you become an investor. Now, as far as inflation goes, it's important to invest because every year your money is worth less, unless you can take whatever surplus income you have and attach your income, or attach your money, relatively speaking, because we're talking about currency here. When you attach your money to assets that appreciate over time, that give you at least a 2% return every year, and 2% is bare minimum. Like if you go to fixed income, CDs, bonds, mutual funds, you can get fixed income. You get your 2-3%. Sometimes they're higher than that, plus or minus. But then you can go into other but more volatile assets that don't give you a promissory return, that can give you, more potential of a return. So that's where you can see the 9, the 10s, the so on and so forth, 20, 50, 100%. Like with cryptocurrencies, like there's a lot of upside to it, especially with the market cap being so down as it is right now. So I hope this was useful to you. This is just an introductory video to these topics. We're going to dive into a few separate things going forward. With that being said, I'll see you on the next one. More love.